Learning Objective 2 starts our description of common transactions and how we do accounting for them. First, the stock is issued by a company to investors to get funding. So what happens? Cash goes up because we just sold some stock. The amount it goes up is the number of shares times the price per share paid by the investor. The other side is contributed capital goes up. And the accounting for it is a little bit tricky, so hang on a little bit. First, we take the common stock that is issued, which is equal to the number of shares times the par value of one share. And all the remaining amounts, you take the total cash minus the common stock at par, equals the increase in the account called additional paid-in capital. Sometimes it's called paid-in capital in excess of par. You'll see both used, but they mean the same thing. It just means extra capital that each shareholder's put in above the par value. Let's look at an example of this. If we look at J&J and they issue 1,000 shares at $100 per share, the common stock is increasing by the par value, which is $1 per share, times 1,000 shares equals 1,000. The additional paid-in capital is the difference in the cash paid, which is the full amount of 1,000 shares times $100 each. That's $100,000 minus the 1,000 that is already recorded as the par value of common stock issued. We end up with $99,000 as additional paid-in capital. And in the bottom, you see the template. We see on one side cash going up by 100,000. On the right side, we see the contributed capital in the account called common stock going up by 1,000, and the contributed capital account called additional paid-in capital going up by 99,000. That's issuing of shares at the beginning of the company. What happens if the company has extra money and wants to buy back some stock? That's called treasury stock. Why would we do this? Well, we buy it because we think we have a good value in the marketplace, in other words, low, and or we have extra money. We buy back some of our stock to concentrate the ownership in the hands of those who are remaining shareholders of the company. The transaction is a little bit tricky, perhaps even a little bit non-intuitive. The first part is always easy. You use cash. So cash goes down by the amount of market price per share times the shares that the company repurchased. It goes out, so therefore cash goes down. The tricky part is we don't buy marketable securities in ourselves. If we bought marketable securities of another company like Apple or IBM or something, it would go into our assets called marketable securities. But if it's our own stock we're buying, it's not that the asset goes up, it's that the common equity goes down. It's an offset to the money we got from shareholders to fund the company. In this case, when we spend money for treasury shares, cash goes down and treasury stock is a negative to the shareholders' equity section. And it's easier to look at by examples. Here's an example. Say J&J repurchases 200 shares at $90 per share. The dollars that's going out of the company is when you multiply $90 per share times 200 shares is $18,000. Treasury shares then goes negative by that $18,000. The template is balanced below, negative 18 on the assets, namely cash, negative 18 on equity, namely treasury shares, and that is the account to show that we bought some treasury shares. Next is how do we see the disclosure in a financial statement for treasury shares. J&J shows that they have common shares held in treasury at cost, 364 million shares, and it shows that it cost them $22.6 billion to buy back their own shares. We can establish the average price paid by J&J by taking the total dollars paid by J&J divided by the common shares, and that was bought to Treasury. That's the average, what they paid back to buy their own stock. In this example, J&J repurchased a total of 364 million. The price was $22 billion. The average repurchase price was $62 per share. And these are legally owned by J&J, but there's no voting rights. You can't vote for yourself, right? That's inside the company. Nor can you pay yourself a dividend. They're in the company, but they're not enjoying the full rights as if they were some outside investor. Treasury shares could be reissued, and they could do this as part of a merger and acquisition transaction, or to sell stock to honor the employee's right to buy some of the company stock. Next is what happens if we reissue the common shares. In Learning Objective 2B, we bought back shares, so now let's sell some. So the example here is the company may use its stock to sell to employees for stock options or in merges. And if so, we then have to record it. First, show that the cash went up by the dollar amount paid by employees because they exercised an option to buy stock. Next, we reduce the treasury stock by a positive entry representing the price paid per share times the shares sold. And then the leftover, or the additional money, adjusts paid in capital. So again, let's look at an example. If J&J sells 200 shares that are bought previously for 90 and it's currently selling it for 95. So cash goes up by what the employees paid, $95 per share, times 200 shares, or $19,000. The shares are reduced in Treasury by the amount of the cost. The cost was 90 a share, so 90 times 200 equals 18,000, and the difference is an adjustment to additional paid in capital. Here you see the template below. Cash goes up 19,000, Treasury goes down, which is kind of a plus to a negative account of 18, and additional paid in capital goes up by 1,000, and it goes up because we bought the shares for 90 and we reissued them for 95. So we don't show that we make money or profit by buying or selling our own stock. Again, that would not serve a good purpose. It's shown as increasing the paid in capital. It's kind of like a buried gain on sale of treasury shares, which we do not run through the income statement. So that's what the 1,000 is. It equals the gain, $5 a share, times 200 shares, which is $1,000.